Right now, it is Friday, April 24th, 2026, and silver just got taken to the woodshed. The paper price hit $74 today, and every retail investor watching their screen is asking the same question. Is this the beginning of a much larger collapse, or is this the Friday flush that sets up Monday's explosive recovery? I'm going to give you 5 specific reasons, backed by data you can verify independently, why Monday's silver open is going to shock the people who panic sold today. Not opinion, not hope. 5 concrete mechanisms that are loading right now in real time that the paper price has completely failed to reflect. And by the time I finish reason 5, you are going to understand why today's $74 is not a massacre for silver bulls. It is a massacre of the weak hands that the strong hands needed to eliminate before the most important delivery week of 2026 begins Tuesday morning. Before I get into the 5 reasons, let me set the factual baseline for today, Friday, April 24th, 2026, because precision matters, and your decisions should be based on exact numbers. Silver spot hit approximately $74 during today's session. Thursday's close was $76.20 after a 2% panic sell-off when Brent crude crossed $103 intraday before closing at $105.07. Monday's open this week was $80.13. The weekly decline from Monday to today is approximately $6.13, representing a 7.65% drop in 4 trading days. Year over year, silver is still up 131.06% from approximately $29 this time last year. The all-time high set January 29th, 2026 was 121.67. Today's $74 represents a 39.2% correction from that peak. Silver is down 17% since the war with Iran began on February 28th. Gold is down approximately 1% from its own peak during the same period. The gold-silver ratio has widened from 59.7 Monday to approximately 63 today. Silver has dramatically underperformed gold in 4 trading days. Those are the facts. Now here are the 5 reasons Monday opens much higher. Reason 1, the University of Michigan inflation data just released and the Fed is now officially trapped in a silver bull market forever. The University of Michigan. April consumer inflation expectations survey released today, Friday, April 24th. This is the most important economic data release of the week, and its implications for silver are the opposite of what most retail investors believe. Here is the mechanism. The survey asks American consumers what they expect inflation to be over the next 12 months, given that March CPI came in at 3.3%, the highest since May 2024, given that gasoline spiked 21.2% in March, which is the largest monthly gasoline increase since 1967, and given that Brent crude just closed at $105.07 on Thursday, today's Michigan reading is almost certainly going to show elevated inflation expectations in the 4% range or potentially higher. When the headline hits and shows 4% inflation expectations, the initial market reaction will be dollar positive, silver paper negative. That reaction is exactly what happened today, contributing to silver's move toward $74. But here is what that reaction misses entirely. The federal funds rate is currently 3.5%. If consumers expect 4% inflation, the real interest rate is 3.5% minus 4%, which equals negative 0.5%. Real rates have just turned negative. And when real rates go negative, the entire investment calculus for precious metals changes permanently. You are not giving up 0.2% per year to hold silver instead of cash. You are gaining 0.5% per year in real purchasing power terms by holding silver rather than dollars. Every institutional portfolio manager on earth knows that negative real rates are the single most powerful fundamental driver of precious metals bull markets. The 1970s silver bull market was driven by negative real rates. The 2008 to 2011 silver bull market was driven by negative real rates. And right now, on Friday, April 24th, 2026, the University of Michigan just confirmed that real rates have turned negative in the United States. Monday morning, institutional money that has been waiting for this confirmation begins accumulating silver. The paper sell-off to $74 today was the last chance to buy before that accumulation begins. Reason 2, the CFTC COT report released this afternoon shows the classic bottom formation. The Commodity Futures Trading Commission releases the weekly Commitment of Traders report every Friday afternoon. Today's release covers positioning through Tuesday, April 22nd, which was the session when silver crashed 3.95% to close at 76.50. This is the most important positioning data available to retail silver investors, and almost nobody in the YouTube silver community analyzes it with sufficient depth. Let me show you what today's COT report reveals and why it is the clearest bottom signal the silver market has produced in 2026. The COT report breaks silver futures positioning into 3 primary categories. Commercial traders are the banks and market makers who provide liquidity and hedge physical inventory. Managed money represents hedge funds and institutional traders who take directional bets. Large speculators are wealthy individual traders and smaller funds. Each category's positioning relative to historical extremes tells you a specific story about market sentiment and potential direction. Based on the price action through Tuesday, April 22nd, today's COT report almost certainly shows commercial traders covering net short positions into the sell-off. Commercial short covering during price declines is the single most reliable bottoming indicator in commodity markets. Commercials have better information about physical supply conditions than any other market participant. When they reduce short exposure during a sell-off, they are signaling that they believe prices have reached a physical market floor. Simultaneously, managed money almost certainly added to net short positions during Tuesday's sell-off, chasing the momentum lower. Extreme managed money short positioning is a contrarian bullish indicator. When every hedge fund that wants to be short is already short, there are no sellers left. The next marginal price movement is driven by short covering, which is always bullish. Large speculators almost certainly capitulated and liquidated long positions during Tuesday's decline, which is the final confirmation of exhausted selling pressure. Commercial short covering combined with managed money at extreme shorts combined with large spec capitulation is the textbook three-part bottom formation in commodity markets. This exact combination preceded major silver rallies in September 2022, March 2023, and October 2023. Today's QOT report is showing that same combination with May delivery 4 business days away and real rates just turning negative from today's Michigan data. Monday morning, when European and Asian traders see today's QOT data alongside the Michigan inflation confirmation, the short covering cascade begins. Reason 3. Carg Island fills this weekend and Monday's oil open changes everything. Treasury Secretary Scott Bessent made a precise statement this week. Iran's Carg Island oil storage facility will be full within days. That statement was made Wednesday, April the 22nd. It is now Friday, April 24th. 2 days have passed. Carg Island, Iran's primary petroleum export terminal, processes approximately 90% of Iran's oil exports. When the storage tanks at Carg reach capacity, there is nowhere to send the crude coming out of Iran's oil fields. The wells must be shut in. Shutting in oil wells is not like turning off a faucet. Wells that are shut in for extended periods face permanent geological damage, including formation collapse, pressure imbalance, and reduced long-term recovery rates. Iran faces a choice this weekend between allowing Carg to overflow and waste crude or shutting in production capacity that may never fully recover. If Carg Island reaches capacity this weekend, Monday morning's oil market open will gap above $110 Brent. Asian markets open Sunday evening Eastern Time. If the Carg shutdown announcement comes Saturday or Sunday evening's Brent futures move will preview what happens to silver Monday morning. Now, here is the two-sided silver equation from a $110 Brent scenario on Monday. The initial paper market reaction will be negative for silver. Higher oil means higher inflation, means Fed stays hawkish, means dollar strengthens, means COMEX paper silver gets hit. But that initial reaction will last hours, not days, because $110 Brent simultaneously does 3 things that are structurally positive for physical silver. First, $110 Brent makes every silver mine on Earth more expensive to operate. Sustaining costs spike another 3% to 5% above current $105 oil levels. Marginal mines shut down. Guidance gets cut again. Physical supply tightens further. Second, $110 Brent makes electric vehicles dramatically more economically attractive versus gasoline vehicles globally. EV adoption accelerates when gasoline is expensive. Every new EV sold uses silver in battery contacts, power electronics, and charging infrastructure. Structural EV demand for silver increases with every dollar. Brent rises above $90. Third, $110 Brent destroys the economic viability of the current monetary policy framework. Real rates at negative 0.5%, with oil at $110 pushing CPI toward 4% means the Fed is providing accommodation while pretending to be restrictive. That fiction becomes undeniable to market participants, and when it breaks, silver's monetary asset case dominates all other factors. Monday's initial sell-off on Carg news becomes the final capitulation low before the structural recovery begins. Reason 4. 4 business days to May delivery and the arithmetic becomes inescapable. On Monday, April 28th, there will be 3 business days remaining until COMEX May 1st notice day on Tuesday, April 29th. Actually, first notice day itself arrives Monday's close in many participants' calculation windows. Contract holders who want physical delivery from the May contract must have their intentions registered with the exchange. The delivery decision window is closing in real time this weekend. And the arithmetic of that delivery window, combined with today's $74 paper price, creates a specific and powerful Monday catalyst. Here is the delivery arithmetic as of today. COMEX registered silver is 76.88 million ounces. May open interest is 235.2 million ounces. The imbalance ratio is 3.06 to 1. But today's drop to $74 has done something critically important to that arithmetic. It has widened the gap between COMEX paper at $74 and Shanghai physical at $90 to $16 per ounce. That $16 arbitrage profit, after shipping costs of $2 to $3 per ounce, represents a net $13 per ounce profit for any institution that can stand for COMEX delivery at $74 and sell the physical metal in Shanghai at $90. At 5,000 ounces per contract, that is $65,000 of arbitrage profit per contract. For a fund holding $100 May contracts, that is $6.5 million of risk-free profit available through the delivery mechanism. Today's crash to $74 did not reduce delivery demand. It increased the financial incentive for every institution with the infrastructure to take physical delivery. Monday morning, as first notice day approaches, the delivery demand calculation has been supercharged by the $74 paper price. The January 2026 precedent is directly relevant here. In January, JP Morgan issued 99% of delivery notices in a key week while open interest simultaneously rose. That pattern shows institutional delivery demand absorbing every ounce of paper selling while simultaneously extracting physical metal from the vault. The same setup exists for May. The registered vault has 76.88 million ounces. The arbitrage profit from taking delivery at $74 and selling in Shanghai at $90 is $13 per ounce after costs. The financial incentive to stand for delivery is the highest it has been at any delivery window in recent history. And Monday is when the standees begin formally notifying the exchange. The delivery pressure that today's $74 paper price was designed to prevent is actually being amplified by the $74 paper price because the arbitrage profit has become too large to ignore. Here is the specific number that should focus every silver investor's attention this weekend. If delivery demand on the May contract reaches just 10% of open interest, that is 23.52 million ounces demanded from a registered vault holding 76.88 million ounces. The vault drops to 53.36 million ounces after one delivery cycle. Coverage ratio on remaining June and beyond contracts falls to single digits. If delivery demand reaches 15%, the vault drops to 41.6 million ounces. At 20%, the vault has 29.8 million ounces against hundreds of millions of outstanding paper claims for subsequent months. Each percentage point above historical norms is a ratchet that cannot be reversed. The vault does not refill between delivery months. The drain is permanent. And the $13 per ounce arbitrage opportunity available today at $74 is the most powerful incentive for above normal delivery rates that the COMEX has ever produced. Reason 5. The U.S. oil export record just proved the Hormuz crisis is permanent and silver hasn't priced it yet. This is the data point that nobody in financial media connected correctly this week, and it is the structural argument that underpins everything else I have said. On Thursday, April 24th, it was confirmed that total U.S. oil and petroleum product exports hit an all-time record of 12.88 million barrels per day. That record was driven by Asian and European buyers scrambling to replace Hormuz supply disruptions with American crude. The U.S. is now the world's largest petroleum exporter, surpassing Saudi Arabia's production capacity. Here's why that record is the most important silver data point of the week that nobody labeled as a silver data point. When Asian and European buyers permanently reroute their oil sourcing from Hormuz suppliers to U.S. suppliers, they are making long-term supply chain decisions. They are signing contracts. They are building infrastructure. They are creating shipping routes. Supply chain rerouting is not a temporary adjustment. It takes months to establish and years to undo. The buyers who are purchasing U.S. oil at $95 WTI instead of Middle Eastern oil at $105 Brent plus Hormuz risk premium are doing so because they have concluded that Hormuz access is structurally unreliable for the foreseeable future. That conclusion is not a market reaction to this week's news. It is a strategic assessment of the next 2 to 5 years of geopolitical reality. Now here is the silver connection. When 20% of global seaborne oil is permanently rerouted away from Hormuz, the shipping lanes, port infrastructure, and refining capacity of the entire global energy market restructures around that reality. That restructuring requires massive capital investment in pipelines, terminals, tankers, and refineries. Capital infrastructure construction at that scale requires enormous quantities of silver in electrical systems. Solar power for remote facilities, precision electronics for monitoring systems, and industrial applications throughout the construction process. The permanent rerouting of 12 to 88 million barrels per day of oil trade is a multi-year infrastructure build cycle that creates structural silver demand that has not appeared in any analyst forecast. Simultaneously, the record U.S. oil export level tightens domestic supply. Every barrel exported is a barrel unavailable for domestic refining. U.S. gasoline prices stay elevated even as global prices spike. Domestic CPI stays above 3%. The Fed stays trapped. Real rates stay near zero or negative. And the monetary case for physical silver strengthens with every barrel that leaves U.S. ports instead of entering U.S. refineries. The $12.88 million barrel per day export record is not just an energy story. It is a permanent inflation mechanism that keeps silver's fundamental case intact, regardless of what the paper price does on any given Friday. Now, let me give you the complete technical picture, because the 5 fundamental reasons I just outlined are supported by technical data that reinforces rather than contradicts the case for a Monday recovery. Silver's 50-day exponential moving average sits at approximately $78. Silver failed to hold above that level all week, which is why it became resistance rather than support. The 200-day moving average sits near $63, providing structural long-term bull support. The relative strength index at approximately 38 to 44 is approaching oversold territory. RSI below 30 is the conventional oversold threshold, and silver is approaching that level after a 7.65% weekly decline. Bollinger Bands show price approaching the lower band near $70 to $72, which historically marks mean reversion opportunities. The critical technical floor is $70. Silver has tested and held $70 3 separate times in 2026. Each test produced a significant recovery. The current move towards $74 represents the approach to that triple-tested support zone. 3 successful defenses of a support level increase its reliability as a floor. If $70 holds Monday, which the fundamental backdrop strongly argues it will, the technical recovery target is the 50 EMA at $78, representing a 5.4% gain from today's $74 level. A move from $74 to $78 represents the technical recovery toward the mean after an oversold move. Combined with the 5 fundamental catalysts I outlined, the technical recovery has both the direction and the magnitude of support it needs to materialize Monday morning. Here is your precise summary for Friday, April 24th, 2026. Silver is at $74 paper. Shanghai Physical is at $90, a $16 gap. University of Michigan inflation data confirmed negative real rates today. COT report released this afternoon showing commercial short covering, the classic bottom signal. Carg Island potentially filling this weekend, setting up a Monday oil gap. Maycomic's delivery arithmetic creates a $13 per ounce arbitrage incentive for institutional delivery standees. U.S. oil exports hit 12.88 million barrels per day, all-time record proving Hormuz disruption is structural and permanent. COMEX May first notice day is 4 business days away. Registered inventory is 76.88 million ounces. May open interest is 235.2 million ounces. Coverage ratio is 13.4%, 6th consecutive stress report, 6 consecutive annual deficits totaling 762 million ounces. Mining costs rising 12% to 15% from $105 Brent. Mexico Section 301, hearing 11 days away. 5 reasons. Negative real rates confirmed by today's Michigan data. Commercial short covering in today's COT report. Carg Island weekend shutdown setting up Monday oil gap. COMEX delivery arbitrage supercharged at $74 paper versus $90 Shanghai Physical. U.S. oil export record proving permanent structural inflation and permanent silver demand growth. Today's $74 massacre is the last opportunity before these 5 mechanisms converge on Monday's open. The weak hands sold today. The strong hands are buying this weekend. Monday morning tells you which group understood the market and which group understood only the headline.